Hey gang, Dennis Tubbergen here with another economic update. Today is Monday, March the 23rd, 2018. There's an article I want to share with you today on the economic update from Quartz, and it's a really great article, and it's got a really nice interactive chart in the article as well. I'm going to give you just a bit from the article. It has a better track record than Nouriel Roubini, Paul Krugman, and many, if not most, high-profile economic forecasters. The shape of the yield curve, that is the arc of U.S. government yields across the spectrum of maturities, has a good record of predicting recessions in America since the 1960s. Now, if you've been watching my economic updates regularly, you know that I took a look at the number of loan delinquencies that exist today, because that's another really good indicator as to whether or not we're going to see a recession. And right now, loan delinquencies are $4 billion higher than they were just prior to the last financial crisis, which obviously was kind of the catalyst for the last recession. This is another one. Now, the article continues. The figure below, taken from a recent presentation by the president of the St. Louis Fed, illustrates how each of the past three recessions was preceded by an inverted yield curve. What does that mean? Well, the 10-year bond yield drops below the 1-year yield. So in other words, you can invest for a year in government bonds and get a higher yield than if you invest for 10 years. And look how predictable this is. Back in the late 80s, back around 2000, and back around 2007, the spread between the 10-year yield and the 1-year yield inverted or went negative, meaning the 1-year yield had a better yield than the 10-year yield. Now, the yield curve has not inverted yet. However, it is flattening. And here's this really nice interactive chart from the article. If you go back and look in 2013, this yield curve looks a little bit more normal. So you've got a 1-month T-bill, 3-month, 6-month, and you see that then as you get into the Treasury notes and then finally the Treasury bonds, you see that the yield curve is kind of shaped as you might expect, with longer term holdings giving you a higher yield. But now watch what happens as time has gone on here. Here it stays pretty traditional, pretty typical, but now look what's happening. We're seeing the yield curve really flatten, and if you take a look at where we are today, you see that the yield curve hasn't yet inverted, but it's certainly very flat. If you take the 1-year, we're at about 2.25%. The 10-year is just under 3%. So we haven't inverted yet. If we do invert, if we invert along with loan delinquencies, I think that will certainly mean that we will be in a recession. In fact, I think we're headed that way now, despite all the headlines and the potentially good economic news. When you look at the underlying factors, when you filter out the manipulated data, it appears that we may be headed for a recession. So that's today's economic update. It is Monday, April the 23rd. My name is Dennis Tubbergen.